All right. So I've talked a lot about it in the plans I do, and I've talked about the different types of accounts you use for investing. But in this video, I just want to talk a bit about what a stock is and what kind of stock you should buy based on what kind of level and experience that you're looking for. So again, I'm not your financial advisor, your investment advisor, so don't take my advice at all. But I'm just going to classify or give examples of three different types of stocks and how you can kind of decide which fits your own personal vibe, right? Okay, so I'm just going to break it down into four different types of stocks, or just different ideas for stocks. Don't take my advice on any of these stocks. Don't buy these stocks. I'm not giving you any advice in terms of what you should be buying. I am just giving you advice in terms of, or examples of different kinds of stocks you can buy. Okay, so the first one, when you buy a stock, you're buying a little piece of a company. Okay, this company is called Canadian Imperial Bank of Commerce, so CIBC. If you live in Canada, you probably know who these guys are. This is how the stock has performed over the last 5 years. Pretty boring, right? Like it's not shooting any lights out, but and this is the last 1 year. Obviously, with everything that's happened in the market, it's been pretty volatile. But the big thing to look at here is what's called the dividend yield. Okay, so what this means is that every 3 months you're going to get paid a part of their profit, and the yield on this is 5.11%. So when you look at this, you can say, well, now keep in mind that these numbers are the stock price, not including the dividend yield, because that doesn't matter where the stock price goes. You're getting paid a certain amount per share you have. The more this goes down, the more valuable the yield is. So, for example, if this is a $64 stock and it's paying a 10% yield, so $6.49, that's pretty good. But the dividend doesn't change when the share price changes. The dividend is set by the company every 3 months when they release their earnings. So if this same stock went down to $50, but it's still paying $6.49, all of a sudden that yield goes from being 10% to 13%. So if you're looking for something that's pretty boring, pays you a nice amount of income every 3 months, and becomes more valuable the lower the shares are, dividend investing is really good. But you're not going to make, 1,000%. These companies are already at a position where they're solid. They're not going to go bankrupt, but they're also not going to be, putting people on Mars, right? They're just kind of tried and true type investments. So dividend investing is usually pretty boring, but the other part of it is you can have it that every 3 months, that income that you get paid buys you more shares, which then gives you more shares paying that yield. So it can work out pretty good, and it's a pretty low risk type of investing. The next one here is the complete opposite. So this company is called Big Digital Assets. It's related to crypto. These are the types of companies that you really hear people talking about more. Like people get excited about them, right? Because you can have it go from being worth 33 cents to, what are we at here? Boom. Where's the high? Oh, here we go, 203. So last year it's been 28 cents and $2.03, which is insane. Like there's people that sold at the top and made tons and tons of money, right? And there's people that held on and they're down here. Now, maybe it will go back up to here. I don't know. Like, if you look over a year, there's times where it spikes up and such. Because this is the kind of stock that's so small that people can get hyped up on it really quickly and you can make a bunch of money. But this is a very risky way to make a retirement fund or to get ahead in life. So these things are called penny stocks because they're so cheap to buy shares. You could go buy 100 shares and, it's not going to hurt you, but at the same time, sometimes they blow up and you make a whole bunch of money. Okay. But usually I say to clients, if you're going to put money into something like this, it's got to be money that you're willing to absolutely lose all of it. Okay. Next one, this is Lemonade. So this is a company that's obviously not a penny stock. It's a online insurance company. It is a company that sells something already. It has a technology. It's actually making money. I don't know if it's profitable, but here we can say, so it just released its earnings. So just so you know, any company that's on the stock market has to release all its earnings every 3 months. That's the deal. So they made, for example, 65 million in the last quarter. So a quarter is 3 months. So pretty good, right? Like it's not the same as CIBC, which makes $1 billion, or I think $1.8 billion every 3 months. But it's obviously a little bit more secure because it has an actual profit. The thing with these companies, though, is that a different company can come out that's better. Like Amazon Insurance could come out. These guys are toast. But they are more interesting. So this is a growth stock. When you hear people talk about growth stocks, you can make much, much more money. But again, when you look at COVID, the stock was $163.93. Now it's 25. So again, buyer beware. You don't want to be putting too much money into this type of stuff. And then the last guy here is Tesla. So everybody loves Tesla. What I've done is this site is called Google Finance, where you can compare them all, where you can just look up, stocks. You just put this is called the ticker, right? The 4 letters or 3 letters that identify the stock on the market. So I just did a comparison between all these different companies. So if you look over the last year, I'll just reverse a bit. So Tesla on its own, worth much more, $871, has made a ton of money. This is kind of, I guess it'd be called a unicorn, where it's one of these little tiny companies that actually makes it and gets very big. Still pretty high risk, because you can see here it went from what's the value there? $1,000, $1,025 a share, all the way down to 663. So that's about half your money, pretty quick. But you can see just because you're buying a stock doesn't necessarily mean it's risky or not risky. It's how established the company is. Another example we could add in here is just Apple, right? Because everybody loves Apple. Right? So you can see Apple here is pretty tried and true, pretty boring. Apple's like the in-between, because Apple has volatility, but not as bad. And it also pays a little dividend, right? So you can see as these companies are getting more established, they start giving back some of their profit, okay? But the main point here is that, let's take that one out. You look at the long-term charts for these, the maximum. If you bought Tesla, you'd make 22,000%. CIBC up 708%. These small guys, these small tech ones, are both down since they existed. You look over the past 5 years, right? So you got Tesla, who's the unicorn that just, 1 in a million, got through all this other stuff these other companies are going through, made a whole bunch of money. Lemonade and Big are still down. CIBC, green, pays you the dividend, really boring. You go 1 year back, right? You got Tesla still up. CIBC's down a bit, but that's pretty easy to recover from if you're getting a dividend of 5.11%. It's not anything that's going to change your life. These crypto one and this insurance one, obviously, that's pretty drastic. And then, year to date, same thing, right? So you can always see the ones that are boring will usually lose the least amount. But these other guys have more trouble as they're trying to, grow and define themselves in spaces where there already is something else. Like, crypto, there already is currency. So they're trying to, fight their way through that. Lemonade is doing insurance. Well, there already is insurance companies. So they're trying to, create something new and exciting in that space. So hopefully that gives some more clarity in terms of what kind of stocks you should actually be buying. What my job is simply to meet with clients and guide them through this process to figure out, okay, well, how much should you have of the boring stuff that you know you're going to have your money over the next 10 20 years. We're not going to be sitting here where CIBC, the bank, no longer exists, right? Even through all of this, you're still fine. And how much should you have in things where you either make 22,000%, or you're sitting there with 78% losses? The thing to remember too is that if you go down 50%, it's 100% to get back to where you were. So if you go down 70%, it's a lot. Like, it's percentages kind of skew the numbers, but CIBC solid, banks are solid, utilities. So I thought that would be useful just so people get a better understanding in terms of the differences with different types of stocks. I'll do another video in terms of ETFs and mutual funds, because those are other investments that really get pushed on people a lot. It's important to know how those tie into everything. But hopefully that was helpful. I'm not going to be the guy to give stock advice on YouTube. I think it should be illegal, and it's a little bit scammy, because you see a lot of these guys with big followings who they'll give you a stock tip, but they own the stock, right? So like, you love these guys who are like, oh, I give you a stock alert when I do a change. That's should be illegal, because essentially what you're doing is you're buying a stock, then you're telling all your followers to also buy that stock, but you made your purchase first. So now your stock goes up as you tell all these followers to buy it as well. So I wish the SEC would crack down, or the IROC or whoever in Canada, because it's honestly, it's bullshit, and it should not be allowed, because there's so many people that lose their hats following YouTube or social media investment advice. I can help people with figuring out how to pick the stock they want to use. And like, that's what I just did. You can easily just start going through different stocks. Think about companies that you use every day, and you can look them up. So you can look up General Electric or Ford or GM, and you could go and take a look at those charts like I said, was showing you, and go, okay, well, this might be something that I'm comfortable with. The other part is that you can always use someone like myself. So if you do want to get started in this, there's different kind of levels you can go through. You can start with your bank. You'll most likely get mutual funds, but hopefully that's helpful. But at the end of the day, don't listen to anybody online. Don't listen to all these social media influencers. Don't buy their stupid courses to make you rich, because it's all a scam. All right. And don't listen to everybody, because what happens is the minute someone buys one of these courses, there's this, self-fulfilling bias where you want to feel good about your purchase. So you're going to tell everybody else it's really good, and you're going to fight for that person that's your instructor or your coach, because that enforces that you made a good decision. But it's all bullshit, you guys. So again, hopefully that's helpful. I'll do some more videos. I'll try and start doing this more regularly, because I know I took a break there, but see you guys there.